So what do you do with that old 401k? I get this question all the time. As a matter of fact, I just got an email asking what to do with their old 401k from a prior employer. So in today's video, what I want to talk about is I want to talk about those 401ks, those old employer-sponsored retirement plans. And how do you get out of them? What do you do with them when you're no longer working there and getting a match? And what are your options? So if you've got one of those pesky retirement plans, so let's check out your options. So this question comes up all the time, and I guess it kind of makes sense that it comes up all the time, because if you look at 401ks or employer-sponsored retirement plans in this country, it's like $46 trillion of assets. That's a lot of money, and that's a lot of accounts. So almost everybody has one of these accounts, just like this email that I got from Rachel. So she has an old 401k from an employer, and when I ask, why did you start the 401k? The answer is almost always the same. It's always one of two things. Number one, because somebody told them to, and number two, because they got a match and tax deductions. So I guess that's three reasons, but you can do the math better than me. So let's just hit those options. You have a 401k, and I do too, or I did, but you have one probably because someone said you should. Well, my grandmother back when I was a kid said to me, Chris, when you start looking for a job, ask them if they have a 401k. Okay, grandma got that, check. And then she said, but if they have a 401k, ask them if they match. I'm like, Grandma, what does that mean, match? And she said, it's free money just for working there. And I said, wow, free money? So if that's the reason you started the 401k, great, but you're no longer working there. You no longer are getting the free money, the match. So that option is off the table. So the number one reason you started the plan was for the free match money, and you're not working there anymore, so you don't get that. So what are the options for that money? Well, you could take your old 401k and you could roll it over to your new company you're working at if they have a 401k. But I always tell people that's probably not the best option, because you're going from one 401k right into another, and you're not taking back any control of that money. Now, if they match at the new one, start a new 401k. Keep your old 401k outside of the new one, because you're doing it just for that free match money. Now, what is another option you could do? Well, you could take that old 401k and you could roll it into a new IRA, an individual retirement account. Now that wouldn't be such a bad option, because now you have all sorts of options. You see, in the 401ks, you're always going to be very limited in terms of what you can invest in. There's a very small menu of mutual funds, and most 401ks that I see in today's world are just those retirement date funds, those freedom date funds. You know which ones I'm talking about, the one that makes it easy. It's like the easy button, click, and everything's done for you. Well, when everything is done for you, what do you think is the counterpart to that? Higher fees. That's right. Those retirement date funds, those freedom date funds are some of the highest feed mutual funds that there is out there. Why? Well, because it's the easy button. Everything's done for you. As you get closer to retirement, the fund gets less and less risky so that you're prepared for a market downturn. But that isn't exactly how they work either. So that's a whole nother story. But let's get out into why would you move it into an individual retirement account? Why would you roll it over? Well, you'd roll it over because there's no tax consequences in a qualified rollover. And in doing that, you could move into a regular Charles Schwab account, you could move into a Fidelity account, a Vanguard account, where you have a whole bunch more investments that you can choose from. Matter of fact, some of you would roll into an account where you could buy individual stocks, individual bonds, ETFs, not just those mutual funds on the menu. So let's table that. What are some other options? Well, Rachel in her email asked about, can I move my 401k into one of these specially designed and engineered whole life policies to use for the infinite banking concept? And the answer is yes, but a big but. The but is you can do that, but you're going to be taxes, and Rachel's not 59.5, so she's then gonna get hit with a 10% IRS penalty, and that isn't gonna be fun either. So taxes plus penalty, I mean, that's just too much money to give away to move money into the whole life. So I usually tell people, don't do that. But they want to take back control of their money, and they want to be the bank. So here is a great option. You can do what I did and what so many other people do. You could roll your old 401 into a self-directed IRA. It is no different than that regular IRA I just talked about with Schwab or Fidelity or Vanguard, except for it's with a self-directed custodian, meaning the custodian you move it to, ones like Horizon Trust, they give you the ability to take your retirement dollars and be in control of where that money is directed. Just like the name says, you directed. You self-direct where you want those funds to go. So what does that mean? Well, that means you no longer are captive to just investing in the traditional investment model, like stocks, bonds, mutual funds, ETFs. Now you can take your retirement dollars, which came from the old 401k, you can take them and you can self-direct them into things like real estate. Maybe you could self-direct them into crypto if you want to get into that. Maybe you could buy gold and silver or precious metals. Maybe you could just be the bank and start lending money like we would have done from that specially designed and engineered whole life using the infinite banking concept. So you see, it's not exactly the same as the infinite banking concept, but you can still be the bank by lending your money from your qualified self-directed IRA into anything that you know, like, and understand. It gives you a lot more options, but you see, it takes nothing away from you. Because some of you are like, yeah, but if I do that, but I still want to buy stocks, great. You can still buy stocks, bonds, mutual funds, ETFs in your self-directed IRA. But on top of that, you can self-direct to all those alternative investments that you couldn't do with the other options. So what are some other things that you could do with your old 401k? Well, this is an interesting thing, and I do want to go back to what I said is maybe not a good option earlier, and that would be taking the 401k and rolling it into your new employer-sponsored retirement plan. And remember, I said that might not be the best option because the limited menu of investments that you have. However, there are rare occasions where somebody has an immediate need to use that money. Now, one of the cool things about a 401k is while you're working for the company, most 401k providers allow you to take loans. That's right. And the loans you're going to take from the 401k, they have some limits like $50,000 or 50% of the value. But if you rolled money from an old 401k into the new 401k, you now have a higher balance that you can loan from. Now, here's the cool thing about loans from 401ks. When you take a loan from your 401k, you now have access to that money. And what can you do with that money? Well, anything you want. But here is what I would suggest you do. I would suggest that you look at all your debts. I always tell people the fastest way to wealth is through their own debts and expenses. And why do I say that? Well, because your debts and expenses usually carry really high interest rates, like credit cards. You got some credit cards? I know Rachel, when I was talking to her, she had some credit cards. But those credit cards probably have a credit card interest rate of between 20 and 30%. So 20 and 30%. Let's just think about that. Can you make 20 or 30% consistently and persistently in stocks, bonds, mutual funds, ETFs? Most people would say, well, you can, but it's not usually very consistent or persistent, right? But you can if you paid off a credit card, right? So hear me out. Let's just say you took your old 401k and you roll it into your new employer and they had a 401k. Now you've got that balance that you can take a loan from. So you take a loan from your 401k, which is going to start charging you interest, okay? We'll get back to that in a second. So you take that loan and you pay off your credit cards. Now your credit cards you were paying 20+% on. So what you do is you take the amount you used to give the credit cards every single month and you now use that money to repay your 401k loan. So what just happened? Well, you recycled and recaptured the money you were giving away to the credit cards, which was over 20%, right? And you just said that that was a good rate of return, did you not? You did. But now, the money you're paying back to the 401k and the interest the 401k is charging you every single month, who gets that interest? Is it the 401k provider? No, it's you. You get to keep that interest. So now you recaptured the interest rate you were giving away to the credit card payments, that's yours, plus the interest that they're charging you on the loan, that's yours as well. So you get to make money twice on the same dollars. So that would be where using your old 401k and rolling it into a new 401k that you can take loans from would make sense. But again, let's just hit those options I gave you. Number one, you could take your old 401k and you could roll it into a traditional IRA. It's called a qualified rollover. And that could be with any custodian out there, from Schwab to Vanguard to Fidelity. And you'll have more investments, but they'll be the traditional investments, stocks, bonds, mutual funds, ETFs that you can invest in. You then, I said number 2, you could roll it into a self-directed IRA custodian, such as Horizon Trust. Why do I say Horizon Trust? It's not because I get an affiliate, it's because that's where I move my money and I've had a really good experience with them. So you could do that, and now you can self-direct the funds in your retirement account, and you can be the bank effectively. Now, the third option I said is you could take your old 401k and move it into a new 401k. And in doing so, that would give you the ability to take loans and use those loans in a better way to make a better interest rate. And I mentioned debts. Take back control of your money and build wealth through your own debts and expenses. So there's lots of options.
And I know it seems very complicated, but it really comes down to what your needs and your goals are. So whatever Rachel's needs and goals are will determine where she moves that money and how she uses that money. And that's what you should do as well. Now, every one of you are going to have different needs and goals. So make sure you're really careful. Write it down. What is your number one objective? Is it to get out of debt? Is it to pay off your car? Great. If you do either one of those, always remember the second thing is you got to make that same payment that you made to that credit card or that finance company. You make that back to your account. And in this case, your account is what? That's right, your 401k. Now let me go into one more thing. You see, there's this book called 501k. I mean, check it out. It's right here. You should really read this book. But it's interesting. The author of the book is the one who actually pioneered the idea of the 401k. So you would think the pioneer of the 401k would love 401ks, right? Well, in his book called 501k, he actually talks about the complete opposite. How 401ks were morphed into something that he never wanted, which forces people, I shouldn't say force, but that's essentially what it does, to give up control of their money. Now, in this book, chapter number 1, he talks about something really interesting. He talks about the Swiss Army knife of the financial world. And he goes through and he talks about all the advantages of the Swiss Army knife of the financial world. He talks about guaranteed interest. He talks about receiving dividends on your money. He talks about the tax-free environment, which he loved the tax-free environment. But you can only get tax-free in a Roth IRA. And if you make too much money, you can't put money in a Roth. And you can only put up to the limits into the Roth IRA. So there's lots of restrictions on those tax-free Roth IRAs. So in this Swiss Army knife, he had guarantees, dividends, tax-free growth, uninterrupted compounding interest. He said all the other things that you get with it, also legacy play on it. And when he boils it down in the end of chapter 1, he talks about what the Swiss Army knife is. Who can guess? He said the Swiss Army knife is good old-fashioned whole life insurance. One of the least talked about instruments, one of the, by some accounts, worst places you can put your money, says by Dave Ramsey and Suze Orman. But he eloquently explained all the benefits of the Swiss Army knife. And not until the end of the chapter does he talk about what it is. But everybody wanted it when he was saying what it does. I think it's important when people are talking about their invested dollars or their retirement dollars to stop focusing so much on where that money should go and in what you should put that money in. I think what people need to do is start thinking about what problem are we trying to solve? What are the things that it will do for me? And what are the features that I'm going to get out of it? I think so many times we put money into things that we don't know, like, and understand, and it does not solve our problem. And we don't think about what our problem really is today and put our money into things that solve that problem today. Not 5, 10, 15, 20 years into the future like the 401ks. So I think in that book, 501k, not just chapter 1, but all the other chapters give you alternatives, places and things where you can put your money, but not so much just where to put your money. What problem does that solve? And what are the features and what does it do? And as I always say, it's not about the product, it's about the process. It's about what the process does to solve a problem. So another thing I think that's interesting about Ted Benna and the book 501k is you try to think about why is he telling people this? Why is he putting this out there? I mean, does he have something to gain outside of just the book sales? Well, I dove into this and I could not find anywhere that Ted Benham was a life insurance agent. I couldn't find anywhere that said that that's what he's doing. He's trying to sell whole life insurance or anything else. That isn't the case. He's telling you this because that is stuff that no one else will tell you. And I gotta believe that a lot of times people don't tell you what's actually right for you, because if they tell you what's right for you, there's no money in it for that. I mean, you hear me say that all the time about these specially designed and engineered whole life policies that we designed for the infinite banking concept. You do realize that by us designing them the way we do reduces our commission by 60 to 90%. That means if you went to your financial advisor or your broke-ass brother-in-law who's trying to sell you life insurance, they would have to take a reduction in their commission or their income of 60 to 90%. Are they willing to do that so that you have 60 to 90% more money? I very much doubt it. So sometimes you got to look between the lines. You got to look behind the curtain to find the real truth. And with that being said, I think a lot of that truth can be found right here by clicking this subscribe button. And when you're at it, there's a little bell up top. I'm gonna try the left hook. Bad. You know, I'm not a lefty and I'm not a boxer, so sometimes I get lucky with those left hooks, but that's what you do. You smash that little bell so you're notified the next time I put new content out. And with that being said, let's talk about one other video I think would be really good. Check this video out right here. How to create a volatility buffer for your retirement plan. I think you'll really enjoy that one. Thanks for joining me, and Rachel, I hope this helped answer your question.